Well, good morning, everyone. I would like to make this interactive. So if you have questions, either kind of stand up and shout them out, because I know the room is large, or grab a microphone, whatever's good. Or if you wish to hold them to the end, that's entirely up to you. Because of the time this morning, and we need to be finished by 11, and John, you'll give me a 5-minute warning. Thank you. I thought we'd talk about something that's a growing phenomenon that's been around a long time, but most people really kind of don't fully understand, and that's the issue of angel investing and how prevalent angel investing has become in the US. So I'm going to go through kind of what it's all about, how it works, and I said, and all that money stuff on this presentation, because in 45 minutes it's very hard to get through, you know, other types of money stuff, be it venture capital or other things. But I'm, of course, open to those questions if it works out for you. I like to recognize the sources of the data, which is the Angel Capital Education Foundation, which is sponsored by the Kauffman Foundation, one of the largest funders of entrepreneurial research and other activities in the country. Founded indeed by Mr. K, who Mr. Kauffman was indeed an entrepreneur himself. And so today I want to talk to you about the important things that you or others may need to know about angel investing. You know, why are we even worried about angels and what they do? Because fundamentally, you all know this, and this is like preaching to the choir. Most of the new jobs since 1980 in this country have been started by firms that initiated their being with 5 or less people, and that's continuing to be a trend today. So while we have, of course, the very large firms, the Fortune 1000, and continue to need them, it's the small guys that are actually creating most of the new jobs. You know, when we talk about angel investing, we thought, oh, lots of little amounts of money. And that's absolutely true. But to put this in context, and this data is pretty much true today. It's very hard, actually, to get data out of angels. But essentially, in most early stage angel deals, if you accumulate them together in the US, we're spending about $20 billion a year in angels investing early stage startup companies with some seed money. Okay? Putting that into context, in the venture capital market that we all hear more about in the US, the venture capitalists are spending on average $28 to $29 billion a year. Early numbers for 2012 came out and it was $29 billion. So within a very small difference year on year. But of course the big difference is angels are investing in over 50,000 companies. In 2008 it was 55,000 companies, where the VCs are moving more upstream, as we would say, and they're only taking about 3,000 to 4,000 companies, actually 3 to 3.5 typically, in terms of what they think will be very high growth companies that could give venture-like returns. But when you put that in context, a $20 billion investment pool versus a $29 billion investment pool, you know, these are significant amounts of money available for early stage companies. You know, when we think about starting companies in the US today, we think about going through several rounds of capital. You know, first of all, we think about using our own sweat equity. Then we think about using what I like to say are the 3 Fs, the friends, the fools, and the families. The people who know you and love you but have absolutely no clue about what you're going to do with that little bit of money. And typically that's a $5,000 to $10,000 individual investment. And then we get to the angels who actively invest, and then onwards to seed funds, VCs, and so forth. You know, there's actually a new category being defined now as a super angel. And I would describe a super angel as an angel who actually is very comfortable investing $50,000 into an individual deal, where typically it's $25,000 to $100,000, most often $25,000 to $50,000. And these super angels are kind of like small VCs, or as we describe them, super angels. So there's almost a new category that's developed over the last few years. And I will mention here that this whole new issue with crowdfunding that you've probably read about in the paper, that is still going through the SEC, will have another effect again. I'm not going to address that today because we could have a whole talk just on crowdfunding. If you look at venture capital deals and you presume that the venture capital deals are coming after some form of seed funding and family, fools and friends funding, you're looking by state at where are there a lot of early stage or a lot of venture capital deals done. And you can see by this chart very simply, Texas is clearly on the map. We always think of California, we always think of the East Coast, but we don't always think about what's going on here in our backyard, or indeed in places like Seattle. And to kind of ratify some of the things that John just said, you know, this is clearly when you're getting these volumes of deals and availability of deals, we're going to have a lot more angel money spent in these areas. Having said that, we like to recognize that as we might say in the venture business, the two countries of North and South California, as we think of them as two countries, you know, Silicon Valley North and kind of LA down, you know, still command 49% of all the investment dollars in early stage companies. And we don't expect that to change, but let me put this in context. For every dollar of venture money, it's hard to determine this with angels, but for every dollar of venture money, 64 cents is managed in Silicon Valley, 18 cents is managed in the Boston East Coast area, and 18 cents is available for the rest of the country, including Texas, okay? We tend to get about 5 cents of that money generally, managed. That's not necessarily where it's spent, but managed. But clearly, we all like to, it's like shopping. We all shop locally, don't we? We rarely shop far away unless it's online. So these stats are important to know because this is why angel investing is becoming more and more important in areas like Texas. Let me give you some of these. Now, you wouldn't actually have thought that these kind of companies were angel funded, would you? Because you just take them for granted as big companies. But every logo on this chart started with some angel money at some point in their early evolution. And clearly, these are the outliers. These are the stars. These are the ones that fly high and fly fast. But when you think about angel money, most people think that small amount of money isn't going to go very far, and therefore that small amount of money probably is going to make a small company. That is not necessarily true. It can be the first link in a chain of financing for a business that could grow quite large. And these are examples. You know, angels matter because they really come in three types, if I may describe them. The most favorite one of mine is the cashed out entrepreneur. And the cashed out entrepreneur has been where that new entrepreneur is today and has felt all the pain and made all the mistakes. And if they can not just put a little bit of their money into a company, but they actually can bring their knowledge is actually probably worth greater than their $20,000 or $50,000 investment. But these cashed out entrepreneurs can be very, very successful angel investors. The second type of angel investor, as I might think of them, is the individual who's a professional with excess income, the doctor, the dentist, the person like that, who has excess income and their choice every year is to go buy a bigger house, a new boat, another vacation. And these folks tend to get involved as an angel. But when they do, they tend to be very passive unless it's an investment in an idea that they fully understand. So if it's a dentist and it's something to do with the dental business or an MD, they can be absolutely fantastic to help you. But they're really there to support you in a more passive way most often. But it's entirely up to their choice. And then the third type of angel is the inherited wealth angel. And that angel, you would think, having never run a business themselves, most often, not always, but most often, you would question what other value other than money they can bring to the table. And what I have learned over time, that inherited wealth angel has some phenomenal networks. And in the society we live in today, talking about a new company, a new product, telling other people about it, getting it linked into some other place that you want to link through someone else's network is very, very powerful and immediately brings trust. I have a friend who's Ashley is a McCombs grad, and he no longer lives in the state. And to my great surprise, I found out one year that he's actually a fourth generation Mellon. Okay, he doesn't have the Mellon name. And one day I was just talking to him about a business that we were both interested in. And I said, well, you really need to get this to the Defense Department. But, that's a big, monstrous place to try and find a connection. Oh, he said, no problem. My cousin works for the Secretary of Defense. I'll just call him and we'll find a way to get in. He's there next week. Amazing. So all these types of angels bring some value to the table. But I think overall, they all can give you some realistic thoughts about the business, some ideas on how to help the business. They can be an ambassador, as I've just described. And they help the small business entrepreneur gain credibility in their field. So angels started off as individuals doing deals. They've actually started to form networks together. Believe it or not, this is the growth of angel networks in the US. There are over 300 networks of angels in the US today. 300. Here in Austin, we have one called the Central Texas Angel Network, and it's actually one of the most active angel networks in the country. Last year, the network invested from CTAN $8 million in totality amongst a number of companies. There's an article in the paper about that today. But the average investment in a single company is about $400,000, sometimes clubbed together by more than one network. An individual network tends to put about $275,000 of accumulated capital from multiple angels into a single deal. But this is a phenomenon that outstrips any other angel activity around the world. And I want you to know that angel activities in India and other places, Chile, Brazil, are actually very different than the way we run the angel activities here. In India, there's only about 4 major angel networks, and a large portion of their capital comes from their diaspora, their Indian brethren that live overseas that have done well, that are sending money back. Here in the US, it's very much a local phenomenon. And while we have the Central Texas Angel Network here, believe it or not, in Texas, there are now 17 networks for angels that you may come across. So who is an angel? What kind of qualifies as an angel? Not just a nice person. They clearly need to have excess income or excess wealth or a good asset base. So you naturally look to the millionaires in the country. You say if you're a millionaire or a multimillionaire, likely that you could be or might desire to be an angel. There's about 4.2 million millionaires in the US, and there's about 930,000 millionaires that have a net worth of at least 5 million or above, believe it or not. Studies have found that from that initial 4.2 million roughly, about 12,000 investors participate through angel groups in the US. And that's not to say there aren't other ways that these individuals participate directly, but I think you can see there is a big bandwidth of opportunity as more and more people become knowledgeable about angel investing. Angel investing has actually been around since 1990. It legally passed the SEC in 1990, and what most people will not know, because these things are done very quietly, is in 1990 when John was nice enough to talk about ATI that we'd started the year before, we also formed one of the early angel networks called TCN, the Capital Network, a predecessor to CTAN today. When we formed it, to be an angel investor, you had to have a broker-dealer do your paperwork for you. And those people are fantastic, but the cost of broker-dealer papership was often more than the actual investment itself. And so some very nice friends in Texas went to Washington, and lo and behold, the SEC changed their rules to allow this concept of angel investing to start. And it took a while before it really took off around the country, but clearly you can see that is a category of investment today. So where do angels really play? They play best in what we find today, a big funding gap between the true seed stage of a company and the true early institutional or venture capital stage of a company. So where we have a gap of $500 to $2 million, or I would actually say in today's market with the economy we've had in the last few years, I take that down to $250,000 on up, is where ideally angels can play as much as they can play at the seed stage before. And it depends on their appetite. I'm looking at 2 angel activities at the moment. One is a group of angels that collectively with a large institution, a larger investor will invest a total of $1 million between 3 angel networks and that larger single investor. And I'm also looking at one that's actually $3 million to bridge the company into actually break even. These numbers haven't changed. Typically, as I've said, the average angel network will syndicate about $250,000 to $275,000, and that network will go syndicate with another network, and the average in total of the combined capital is about $400,000 raised, as shown in this chart, in terms of the average percentage of funding amounts raised. I expect you will all think I'm actually an optometrist because this is truly an eye chart. But what I'm really trying to show you here, and it's really hard to show you, is on your Y scale, you will see industry types, from biotechnology at the top line to software being the second line from the bottom. Angels have no preference in the deals they do. They may have individual preference by what they understand and they may like to participate in, but angels will invest in any types of businesses. Okay? We all know VCs have their own bias. As a venture capitalist, I happen to do software and clean and renewable energy and a couple of other categories. But angels really will invest in any types of companies. So it will not be as segmented as you will find other types of capital. But angels are an interesting group of people because there's some psychology to the angel themselves and how they work, and there's certain other requirements. And one of those requirements is geography. Just as I used the shopping analogy earlier, angels tend to like to be within 2 hours of wherever they live, their drive, okay? And certainly don't really want to be more than 4 hours away. Now, 4 hours in Texas, I've learned since I've been here, is taking the company plane called Southwest to just about anywhere in Texas, right? And 2 hours is certainly anywhere in the Central Texas region, really from San Antonio on up to probably Waco. But if you were sitting in Silicon Valley, what do you think 2 hours would do on Route 101 at rush hour? That's about 5 miles, right? So your opportunity, if you're an angel in Texas, gets you to a far broader set of companies that you might otherwise think. But it is a true statement to say the reason we have 17 angel networks in Texas today is because they are regionally based. But the phenomenon I am seeing that's really just starting to take off, and although I've mentioned it twice already in this talk, is this concept of syndication between the networks. That $3 million opportunity that I mentioned is being looked at by CTAN, the Central Texas Angel Networks. It's being looked at by Cowtown. They have some interesting names as far as I'm concerned. Cowtown is the Fort Worth Angel Network. You know, perhaps we actually need a Longhorn town or something. And it's being looked at by a third network out of San Angelo, Texas. So it's kind of amazing. But we're now seeing, we're networking this phenomenon between states. So there's a company in town who I cannot name at the moment but has Nebraska angels in the deal with Texas angels. So they're actually spreading that opportunity. So we don't have to be in Silicon Valley and only go 5 miles to get other opportunities. Your average angel network has about 50 or less people in it, 25 to 50, although again, Central Texas here now has just about 100 angels in it because of some of their early successes. If you're interested in angel data, you can go to some of these websites, whether you're in Europe or here in the US. And that will give you information about what angels typically look for, what the expectations of those angels are. You know, angels don't just give money, they really do bring a lot of talent and expertise and knowledge. As I've described, it may be a connection, it may be experience, it may be lots of things. And in most cases, they may want to become an advisor to the company, especially if they have built a business in this area. But many of them, or even a board member, which is very hard for an early stage company to get today. But in many cases, the angels are passive. So they don't want this to be their primary opportunity. They want this to be just something that they're involved in. Sometimes it's because someone helped them 20 years ago to become successful. They're going to do that for someone else. Other times, it's an interest level of these angels. Believe it or not, in the 5 years, and this is just before the downturn, the annual internal rate of return as calculated on the data that was produced showed that angels actually gave a an internal rate of return of 27%, or on average 2.6 times their money back in 3.5 years. I do not want to disillusion you, okay? There's NASDAQ in the same time period, okay? This is high risk. Make no mistake. If you think venture capitalists take risks, that makes me look really safe in my investing compared with angels. This is very high risk. And what we're starting to find is in most cases, angel investments will fall over and play dead, as we would call them. Or another term would they will be lemon-like and not work in the first 1 to 3 years. If they pass that time frame, the majority of angel investments return their capital with any profits in the 6 to 7 year time frame. 6 to 7 years, okay? Since 2001, the average venture capital investment, which remember comes at a later stage, but is typically targeting a higher growth company, is taken on average across all categories of investment 9.4 years to exit that deal, okay? So you've got some mixed data there, and I'm honestly not completely confident that the data we have on angels is precisely correct. I have more trust in the longitudinal data we have on the venture capital business, but they're not so different that there might just be a margin of error. So when you're trying to, perhaps you're an entrepreneur and you want to get some angel money, this is a very typical process. Typically, most angel networks will meet periodically. Some meet very often, monthly. Most meet closer to once a quarter. And in that quarter, they'll collect all their business plans. They'll do online submissions. There'll be a screening capability within a subset of the angels, normally managed by an executive director. Then there'll be a general meeting where 1 to 3 plans with entrepreneurs will get presented. Here in Seatown, we typically will present, in fact, there was a meeting last week. They presented 3 new opportunities that had been screened from the 30 plus per month that were submitted, down to 3, and then 4 other opportunities that had previously been presented and had got some capital but were still needing to finish their round. By the way, some of these companies, one of these companies that previously got capital was actually coming back for growth capital. They were already past break even, they were profitable, and they were looking at growth capital and preferred to come back to the angels for that. And then typically, if there's any interest from any of the angels, there'll be one of the angels will take a lead on some of the due diligence, or they'll split the due diligence amongst 2 or 3 or 4 of them. one with knowledge in marketing, one with knowledge in finance. The angels will use their own skills. They'll come back together, talk about the deal, and then individually they will decide what to do. In states like Kansas, this is deemed to be such an important level of economic activity for the state that because the state also has a state income tax, an angel investor in Kansas will actually get a 50% tax credit the year they put their money into an early stage deal as an angel. Of course, here in Texas, we do not have a state income tax. Thank you. We do not get that tax credit. But you'll find there's different ways of doing these things across the country. And I'll use Kansas again. And when the Kansas angels invest, they club together in a partnership, and it's an investor of one unit, one named unit. In Texas, it's not. It's the individual names. And one has to really carefully look at this if a company is going to proceed on to venture capital or other types of money, because we tend to like fewer investments the more. So I've told you the kind of screening process. The only thing that's important on this chart is to know that of every 100 business plans submitted by an entrepreneur, 1 to 4 will get through the whole process and raise capital. So we may think VCs can be vulture-like and ugly and tough. We probably take 1 in every 500, but businesses that we might fund. But angels have their own culling process, if I could put it that way. To get to there, the angels or the entrepreneurs have to hear an elevator pitch that takes no more than 2 minutes to get their attention. Then they'll look at an exec summary. Then they'll have the classic PowerPoint slide for 20 minutes. And then they'll finally look at the full business plan. So I don't want you to think that angels are just throwing their money around. They're not. They're doing their own diligence that's relative to their level of activity and how much time they want to spend. But again, we come back to the psychology of angel investing. And if you look at a scoring sheet of how they may choose their investments outside of they know this industry space or they know this person, it comes down essentially to 2 issues. If they believe this is a good management team and this is this opportunity for this company, this business, this product is large, then that typically takes about 55% of their weighing on their decision-making process. And if you look at everything else, the things that we would normally look at in other stages of investment, the product, the service, the sales channels, the size of money being round, hell, even the quality of the plan, they almost don't make any difference, okay? Even though these are important to get to that stage. Fundable management teams, given that's the largest single attribute, is someone who's experienced, of course, although many startups at the seed stage do not have experienced CEOs. And that experience is in the area of this new business. And probably the most important attribute is that CEO is believed to be coachable. I'm sure we have many A-type personalities in this room, and sometimes my husband will tell me I'm not always very coachable, even at home. But we want this to be a partnership. And this partnership, this coachability becomes a very key aspect to angel investing. The angels look typically for a business that can scale to at least 30 million in revenues within 5 years. Now, you know, that's what they tell us. I'm not honestly convinced that that's always what they think of at the time, but generally that's their belief. We won't go into term sheets. But one of the fallacies is when you've gone through this process as an entrepreneur and you've got these angels together, and you've closed your deal, that, hey, that's when the hard work is done. It's actually not. Now the entrepreneur has the capital, and that's when the angel really the entrepreneur really needs to understand the terms of what the angels will start putting together for that capital round. Now, if we were going back 5 years, I would have told you most angel rounds were convertible debt. So it was debt where they wouldn't put a value on the company, and at the next round of capital, some independent party would determine the value of the company, and that debt would be converted. Today, we're seeing more and more angels actually take equity and preferred equity, like venture capitalists will, in with their investment. And in fact, some will not even do a convertible debt round. Okay? The benefit of doing a convertible debt is you don't have to try and value a business when there's nothing there to value, or very little. You can't really believe the financials, and you can't do discounted cash flow. You can look at industry comparisons. So you'll find, as a result, most average values of deals that angels do will be $5 million or less, regardless of industry, until they've got to the point where the entrepreneur can show greater traction or greater results and are coming back at a later stage rather than the first stage of investing. And I have some slides on terms, but because of time, I'm not going to go through them, but leave you with other sources of information on angel investing. The one last thing I'd like to say is an angel has to be a qualified investor. And a qualified investor, according to the SEC, is, and it's changed recently, but it's essentially an individual with an income of $200,000 a year for the last 3 years, or a family income of $350,000 a year for the last 2 years, and a net worth of $1 million that does not include the equity in one's home. That changed a year or so back. It used to include the equity, but with the mortgage crisis, that changed. Interestingly enough, the Jobs Act that was published and approved in April last year, that includes the crowdfunding part of the bill, is now requiring that in the crowdfunding scenario, and crowdfunding can only be up to $1 million, as the rules are written today, that the qualification to be a crowdfunder is likely to be the same as to be an angel. So it's going to be very interesting to see if crowdfunding dilutes this angel concept or takes the angel to the lower level being crowdfunding. You can invest up to $100,000 individually, actually between $1,000 and $100,000, but with most people at the crowdfunding level investing at the $10,000 level. So is crowdfunding actually going to cannibalize some of the angel networks, or is it actually going to formalize some of the family, fools, and friends network? It's really not very clear. And until the SEC gives the final rules that will be that are due in April this year and probably implemented in June, we really won't know. But when you think this category is $20 billion of investment a year, I think you should know about it, because you never know when you, your son, your daughter, your cousin, your friend will start a business and need some early stage capital. On that, I'm going to finish and ask if there's any questions. Or if I wowed you all so much. Thank you.
Excellent talk. Could you offer a couple of observations of motivation?
Yeah, ultimately, angels are in the business to make money, but they tend to each have a secondary reason for doing it. The cashed out entrepreneur angel typically says, someone helped me at some point, and without that help, I wouldn't be here today. So money is certainly a requirement in terms of return. We're finding other people are retiring early. They have time on their hands. You know, everyone's living longer, thankfully, okay? And they want to be active. They don't want to vegetate. There's only so much golf they want to play. There's only so many trips they want to go on. They want to keep their hand in. And these people, I mean, when people retire, you're getting people who have peak knowledge and wisdom about things that a 20, 30, 40-year-old doesn't have. And so they want to share that capability with someone else. Now, if they can share that capability and get some return on that by also putting a little bit of money with that, then those are some of the driving factors I have observed. There is, of course, I can't deny, there's the social effect of getting a bunch of angels in the room that can all invest, because frankly, there's angels in this room. I may not know who you are today, but there are angels sitting in this room, and some I actually do know. But you're not going to go around with a big badge saying, hey, I'm an angel, I've got money, I can invest, right? That's not what you want to do. You don't want to be kind of bombarded by people. So this camaraderie, these networks, give you other information that you're learning and sharing about what's going on in the angel field. So those tend to be the most reasons I see or I hear. Any other? Yes? Yeah, and yes, I'm sorry. The question was, and please correct me if I'm wrong, do I see any tax advantages coming up for this type of investment under this present administration? I think there may be, and I should say I'm a recovering chartered management accountant, so, but I'm not a tax person. So I think there will be, but I think it will come in perhaps indirect ways. I think it may come through R&D tax credits that used to be around back in the 80s for limited partnerships, where you put early money in, it was used for R&D, and it could be written off it could be a pass-through and written off on the individual investor statement. I wouldn't be surprised if we get some of those, and that would make a lot of sense. I wouldn't be surprised if we have continuation of, the long-term capital gains. Once you've been in a company for more than 5 years, the capital gains rate, I would actually like to see that be less than if you just put your money in for a year, made money and took it out and pay at a higher rate. I think those are certainly some of the things. It's beyond that, I'd honestly be guessing at the moment, but if you believe that this category of investment is aiding the creation of new businesses and new jobs, of which there's 600,000 new incorporated businesses in the US a year, and about, let's face it, less than 10%, only about 55,000 get angel money, and only about 3 get venture capital money. If you believe we have to keep that engine going compared with other countries in the world, I have to believe there'll be some more tax issues that will look at this to foster this activity. Sir? Did you say the new regulations for crowdfunding? Okay, this is what I know so far. Crowdfunding started for areas other than usual businesses. They started for arts businesses, actually, if you were trying to do a game or a movie or a toy or something like that. And when these first started, such a network would be called Kickstarter, if you've ever heard of it. When the investors invested, they didn't get equity, they got a copy of the product. If it was a toy, they'd get 1 toy back. That quickly moved to the concept of crowdfunding as we know it today, where you take equity. And this is really what the SEC is struggling with today, because there's 2 forms of crowdfunding. You don't have to be a qualified investor if you put up to $1,000 in a deal, and the deal raises up to $100,000, roughly. But if you want to put $10,000 to $100,000 in a deal, it cannot be more than $100,000, and raise up to $1 million, then you have to be an accredited investor. Now, how it's that legally can't take place at the moment until the SEC gives its final rules. How those final rules will kind of work out, I'm kind of not clear. But I'd like to bring a third category, and I hope this is answering your question. The third category that I'm starting to see that I actually think could be quite prevalent, and actually as an investment, I think it actually could be as an investment entity could be strong, is I'm starting to see crowd-funded debt, okay? So instead of it being for equity, it's for debt in the business that will be repayable with an interest rate that tends to be slightly, in most cases, slightly sub a bank rate, but in many other cases, higher than the bank rate for an early business that wouldn't normally qualify for that kind of funding. So I think that's the one to watch, because I actually think that could move faster than the equity-based funding. And this is where people won't put 100,000, but will probably put you know, the $50, the $100, the $1,000, I think.
Are there any
The question was recognizable trends on the state of innovation with these kind of funded companies. You know, I can only give you my personal observations. I don't know of a study yet. In fact, that would be something, that would be a good research project. Perhaps we could, McCombs can do that. My personal observations was that where the early stage of angel investing went into companies that the angels felt comfortable and understood. So it may be product manufacturing of some kind. So you could see the product and they just needed money to manufacture more or buy materials. Now, the angels go into exactly the same space as the venture capitalists. So they'll be going, forgive me, long on, you know, the most high tech. An angel deal I just worked on about 3 months ago was actually technology that was licensed out of one of the University of Texas system components, not Austin. And it was a machine that produced nanomaterial fibers. And you'd say, what's an angel know about, you know, nanomaterial, whatever? But that company got going with angel money, $1 million round, came back, which is rather large at the first round, came back, got some more money, and just closed its final round with venture capitalists and strategic investors for $15 million. So I've seen them go from that manufacturing, that widget, that poster, that T-shirt, that whatever it may be, all the way up to that other extreme end of technology has been my observation. But I need to say, that's because we live in Central Texas. And we are, as John has mentioned, we are a hot spot for entrepreneurial activity, you know, not just in the nation, but recognized worldwide. Not wishing to be the next Silicon Valley, but wishing to be the strong environment that we are today and the reason why we haven't had such a downturn in our economy. So.
Can you speak to the frequency that the structure of angel financing
Yeah, so the question was the structure of angel financing vis-a-vis follow-on investment like with venture capitalists, and are venture capitalists or the like likely to highly dilute the angels on a subsequent round? So let's answer the first question. One of the things that frightens, excuse my language folks, the bejesus out of venture capitalists is to get a term sheet that's been funded by angels and it's got 60 names on it or more, or frankly 30 names on it or more. Because what we think about is there are 30 parties we don't know, we will probably not get to know well, but somehow we've got to get them to sign off on all that paperwork that we're going to do on that round of investment. And that's actually pretty onerous. Normally VCs like to keep a round of investment between 3 to 5 of them if we can. Sometimes it gets bigger. But you know, you've got a manageable number of people to sign off and agree on the paperwork. The problem with angels, if you get an angel that's new at this and they really don't understand what's going on, it takes a lot of time to explain, which is not the new capital source's responsibility, but has to take that on. And then people think they can start negotiating. Well, there's one thing when you're negotiating with one party. There's another thing when you're negotiating with 30 of them. So if the number of angels gets too large, it's a deterrent for a follow-on source of capital like a venture capitalist to look at a deal. And this is where states like Kansas, where they bring the angels together in a partnership and have one representative, actually is preferable. Now, having said that, I've seen many, many deals here and in other places like Pennsylvania where it's kind of being, it's becoming the norm. And so if the opportunity is good enough, sometimes the institutional source of capital, the venture capitalist, may take the risk. But there is also the point that once you get over to 100 investors, you are a regulated financial institution. So the other thing is don't get to be so many, because if one of your angels gets divorced and you tip you over to that 100 mark or that 101, you're de facto a financial institution, and you kick in all kinds of other paperwork that cost you more than the money that was put in, probably. So we try and look at a smaller number. The second question is, do VCs, I'm going to take the extreme view, do VCs dilute angels? VCs will dilute anyone they can if it's good, if it's an appropriate amount of money for a deal. I think that's true of anyone else as well, by the way, not just vulture capitalists. It's in a follow-on source of capital's interest to keep the other investors friendly, and we really don't try and dilute them out of their ownership for any old reason. You know, this is where that first stage of investment becomes key, because if that first angel investment was a convertible note that converts into that venture capital round at some discount or with some warrants, then the angels got the benefit of the VC doing all the work on the valuation, knowing its appropriate market pricing, having the data, and by the way, it may be a 20% discount, so that angels converted their money and got that much more than the VC has paid per, i.e. more shares proportionately. Where the angels are going in and valuing the round, because they don't like that uncertainty, there is, angels tend to be a little bit more generous with the entrepreneur sitting in front of them, and tend to not always have the same amount of knowledge or experience an institutional investor will have. So I've seen it both ways. I've seen big up rounds and the angels are great, and I've seen some times when they've got diluted. But in most of the people I deal with, both on the venture side, we wouldn't purposely go in to dilute the angels out and be vulture-like. Why? It's very simple. The biggest source of new deals that people will send to us are the people that have funded the one now. And if you treat them badly, or they think you're going to treat them badly, with no rational reason other than greed, they won't send you any other deals, or the word will go out not to let one of their entrepreneurs come to you for a later investment. So I think you always have some, and this is where angels get too enthusiastic for that team and are willing to pay more than what others believe the market's worth. I think I am finished in time, and I thank you so much for the time this morning.